federal banks, big challenges. The Fed's challenge is whether or not to cut again. But everybody's, one of the similar things is the impact of the global trade war, uncertainties hitting businesses. What about New Zealand? Because you just did that 50 basis point rate cut. It was surprising. It had an impact. Where are you now?
Well, I hope it has had an impact. Too early to tell, of course. I mean, the idea is to get people out there investing, spending, feeling confident about the economy. And they should be in New Zealand. We've got maximum sustainable employment, very low unemployment. Inflation is near the midpoint of our band. But looking forward, we were saying everyone is telling us we need to be lower. Everyone is telling us the global growth is slowing. So let's get ahead of this. Let's move now and reduce the probability of having to do a lot more later. And so we're pleased with where we are.
Are the downside risks materializing? You just had the Bank of New Zealand Manufacturing Index post its first drop below 50, so it's signaling contraction now, since, in 7 years?
Yes, I mean, without doubt, it's been a lot around the uncertainty. Really hard to get ahead of because the trade has been fine. Our terms of trade are good. Our government fiscal position is very strong. The government is outspending. But that global trade uncertainty has held everyone back from investing. So it's the business confidence and the investment that is the anomaly here. And I think that's globally.
Well, when you look down the road, because people are already talking about the next cut, maybe not 50, probably something more like 25 basis points, are they on the right track? Is that the decision you have to make? When to cut rather than if to cut?
No, I think we certainly don't hold out from doing anything. We will do, to quote, whatever it takes. We like to think that we are in a positive position where our exchange rate has come off. We're relatively competitive, particularly against the US, and really we're in a position to say how much of this global slowdown actually manifests into New Zealand economic activity slowdown. Likewise, we have government fiscal policy spending, very low net government debt. So, it's in a good position where, we can afford to watch, wait and observe what is happening. We've already, taken a preemptive double cut.
So a double cut indeed, 50 basis points. That saved time, didn't it?
It does. I mean, interesting. People say it surprised people, but the forward curve was there. Every economic commentator was there, 50 or 75 points, and then they were all surprised we went there.
Well, so what are you watching now? What is going to be the trigger that you say, okay, we can't wait, we have to go, we have to do another 25?
I think inflation expectations are important because it's much harder trying to lift inflation expectations if they are declining. I'd far prefer to keep them anchored where they are, which is around the 2% mark, out the midpoint. And as long as we can keep people concerned, expecting higher inflation and seeing that pass through into wage costs, then that's a good thing for the central bank. Things that would trip us the other way, sudden significant declines in inflation expectations, and likewise government not being able to spend as quickly as what they are projecting to be able to do. So the fiscal impulse being slower or later.
But it seems to me that if people are talking about November for the next rate cut. Is fiscal spending going to make that much difference between August, late August and November, that you could really count on that?
No, which is why we think, 1 to 2 years ahead, really. And it's a lot about there's government consumption, which they call paying people. There is government investment, of which there's an enormous amount planned, but very difficult to get in place. And then there's other welfare transfer payments. So there's a lot of different moving parts of the government fiscal spend that we'll watch carefully. And it's really around the ongoing commitment and place to put it. Likewise, we don't expect interest rates to be suddenly magically turning spending around. We know that people will be uncertain. One fear we had of doing a double cut was that people would think that we can see something that they haven't seen. The answer is no. We're simply saying, this is where the market thinks we need to be to meet our objectives. We agree with that. Let's get there now.
So are you saying it's your working assumption right now, your working hypothesis is the 50 basis point cut was enough and you probably won't have to do more? Is that what you're saying?
No, I'd say our working basis is we will have to see what the situation is in November and be willing to continue to cut if necessary. We used the kind of our risk analysis. We said in a year's time, looking back, what would we most wish we had done or most regretted not doing? And that really drove us to a bigger cut. You know, sitting in an economy where we have to actually think about raising interest rates in this environment, what a quality problem that would be. You know, that actual economic activity is stronger, inflation's picking up, versus the opposite, where we were too slow, did too little, and we are trying to talk inflation expectations back up. We know how hard that is globally.
How much does it factor into your decision-making process at the Reserve Bank of New Zealand, trying to keep ahead of other central banks? So a lot of people are looking the same kind of forces and having to move. Is it important to try to stay ahead of some of them in terms of policy easing?
I think it's really important to have all channels of your monetary policy operating to relative price signals. And I say that carefully because, one, there's the interest rate channel, but for a small open economy like us, there's the exchange rate channel. And if countries are cutting more rapidly and our exchange rate is being forced up, that becomes an issue for us. We think we're letting go of one good channel of economic activity. So again, just, you know, at least keeping a proper eye on the global forces, adding on to that the local economic issues, getting the balance right. And that's why we're at the 1%. And we've been talking very openly about zero bounds, because now's a good time to talk about it.
In fact, that's why you've been raising the possibility of getting to zero lower bound. But before we get there, what is it that you're worried about getting you there? So, I mean, is it going to be the global trade war not getting worse and worse? What is it that you're going to say, oh, my God, here we are, or we're 50 basis, you know, we're almost there, and we better pull out that unconventional toolkit? Yeah, what's the big risk here?
I think it's the big risk is people. People talk themselves into situations that aren't necessary. You know, I can't overemphasise how supply constrained the New Zealand economy is. Employment is the number one challenge, finding people. The capacity constraints always and everywhere. The infrastructure deficit is very large and we need to invest. Yet businesses are sitting there saying, oh, we're hearing these stories globally, we're not too sure, oh, this is a Labour government and we liked the other ones. You know, these types of conversations. And you're thinking, focus on the long term. You are in an amazing position, the economy of New Zealand. Time to invest, time to transition from traditional production into more productivity, time to build infrastructure. And of course, with interest rates as low as they are, the hurdle rate to investment's very small.
And of course, at this conference, kind of around the world right now, everyone's waiting to hear Jay Powell speak, and does he signal there's more rate cuts? We've had Esther George, president of Kansas City Fed, she's not ready to move, etc. But what I want to ask you is, what would or will a Fed rate cut or cuts mean to your policy path? How does it affect you?
There's a direct path. It would be interest rate differential could lead to some short-term exchange rate behaviour, but I'd have to say that direct path is very short-lived. What I'd be far more interested in is what would that additional stimulus do to the economic engine and for the demands of goods and services that we produce. That's the main path for us. So at the moment, globally, the international trade path remains positive for us, even with the talk of uncertainty. The financial markets have been well behaved, touch wood. It's been this confidence path that has been the big bugbear, something we know least about.
Lately, there was a couple of weeks when so many Asian central banks cut their rates. And of course, sort of the knee-jerk response is, oh, look, currency war. You know, yeah. And of course, Asian central banks are looking at a lot of things you are. There's a global trade war. It's getting worse. It hasn't let up. Donald Trump on September 1st said, hey, he's going to ramp things up on China. How do you respond to that? Or what do you say to people? Or what is the difference between cutting your rate because you think you need to or in a currency war?
I would say vastly different, and I wouldn't even consider a currency war, because that is a race to the bottom in a negative sum game. You know, an exchange rate is simply a relative price. I would want people to truly think hard about why would they be holding a New Zealand dollar denominated asset for the long-term economic reasons they want to hold it. Worrying about short-term money market volatility is interesting, but it's not going to inform you. In terms of the tools of a currency war, I'm not even sure what they would be. Interest rates have a limit. Intervention can work temporarily in some situations, but it's not a long-term path. Long-term path is about productivity, low inflation, maximum sustainable employment.
Unconventional tools. Apparently, you're a fan of negative rates. Would negative rates boost inflation? Would negative rates encourage people to spend? You know, when Japan made their small little move a few years back, people bought safes to put their yen in. Why would that be a good move?
By the way, fan was exciting. I did talk openly about negative interest rates versus other quantitative tools, and so you know, dare I have expressed that. But the reason I think about negative interest rates is because they are a very impactful tool across a very broad sector of the economy, rather than having to narrowly target the winners or the losers when you are buying or selling particular assets. All tools are useful. Some could be more effective at times. I like the interest rate one as well, because in a sense, really, if you can get rid of the arbitrage between holding cash and or receiving a negative interest rate, it's far more economically efficient and less distorting to relative prices than deliberately buying specific sets of assets. Having said that, I would want to have the full suite of tools and be able to have use and access to those in a knowing way. The interest rate one also brings in less concern around I suppose, political interference. It's traditional monetary policy. You're not asking to use the checkbook in a different way.
When would you say, okay, now is the time to start using any of those unconventional tools? Do you have to see that you're in a recession? Do you have to see, again, that you're just 25 basis points above the zero lower bound? When we look down the road, what should we be expecting to see?
I think for us it's easy to talk about, because when our forward-looking path for inflation and our forward-looking path for nominal interest rates, which we produce and provide to the market, when they are suggesting things are negative, it means that we will be thinking about the tools. At the moment, that is far from our central scenario. We have growth picking up, inflation picking up back to the midpoint because of our monetary and fiscal stimulus. But should a shock happen and we are looking at you know, in the near term, declining, if not negative interest rates, well, then that's when the other tools are going to be used.